Good morning from our global headquarters in New York. I'm Danny Berger, Manish Cranny off today, but we'll be back with the show next week. Welcome to Bloomberg Brief. Let's set your agenda. Beijing's warning, China vows to hit back with all necessary measures after President Trump unveils additional tariffs. The deadline remains. Trump also promises Canada and Mexico tariffs on March 4th, sending U.S. stocks towards their worst week in nearly 6 months. And liquidity risks, the SEC raises concern over Apollo and State Street's private credit ETF. We'll speak with Doumar of Park Square Capital later in the hour on the state of the industry. We are back into the red for U.S. stocks for the year, and we are headed for our worst week since September. We are moving higher this morning for your S&P and NASDAQ, both up about 1/3%. Russell 2000 struggles to find its feet. All of this coming after a day where Nvidia fell 8.5%. It's trying to move higher this morning, up by 0.5%. By the way, that is its worst reaction to an earnings report since August of 2018, back when gaming was still its biggest revenue driver. So all of the risk off, driven by tech, driven by tariff fears, also means that you got somewhat of a bid into the front end of the curve. That somehow managed to drop lower yesterday. We're little changed today. We're about 4%. Two-year yields, they are around a 4-month low. The 10-year yield, that yesterday ended its run as 6 consecutive declines, though it is, let's call it about a basis point lower this morning at 425. Now, some individual stocks we are also keeping our eye on this morning. HP, that is one of them. Let's take a look at that in the pre-market session, how it is doing, lower by 3.4%. It gave a profit outlook for the current quarter that fell short of expectations. It also cited the impact of rising component costs and tariffs on goods from China. Meanwhile, shares of Monster Beverage rising after the energy drink maker's fourth quarter topped estimates. Those shares up 3% in the pre-market. Net sales also roughly in line with expectations. Now, Bitcoin has also been falling quite considerably this morning. The rout is deepening, so some of those Bitcoin-related stocks like Coinbase falling. Bitcoin down 5% this morning at around 80,000. In general, investors rushing to safe assets in some of the wake of President Trump's latest tariff threats. Also, some individual idiosyncratic issues with Bitcoin and crypto as a whole that have been sending it lower. And coming up in the hour, we will be catching up with Cayla Seder of State Street and Doumar of Park Square Capital. Now, first, as I mentioned, a stock that we've been keeping our eye on all week, Nvidia, a really tough day yesterday. They fluctuated all day, but eventually closed down more than 8%, something like 8.5%. Markets, I guess, weren't too impressed by the guidance after the chip giant posted results this week. Most analysts still see the stock rising. The latest call is a buy rating from DZ Bank. Joining us now for the day 3 fallout of Nvidia, Bloomberg Intelligence tech analyst Matt Bloxa. Matt, I was just looking at this. The worst earnings reaction to Nvidia's set of results since 2018. It took us a while, though, to actually get to the sell-off. What do you just make of some of the price action we saw yesterday?
Yeah, I think this is a really tricky moment for Nvidia and just generally the AI market, because obviously DeepSeek really ruffles some feathers about the economics of AI going forward. And that's going to take quite a while to play out. I just don't think we'll really get anything close to clarity until we're well into 2026, if I'm honest, because this year dominated by those huge CapEx budgets for people like Meta and Google. And that's really what's kind of fueling Nvidia's demand. And, that's about 50% of Nvidia's sales come from those kind of big tech companies. And alongside that, you've got a huge number of AI startups of various sizes, all deploying capital into the market. And I guess the big question mark is, what is the return on investment on AI going to be? And is that going to sustain Nvidia's revenue base where it is today, push it higher, or maybe even kind of push it into retreat? And, I think you're seeing a lot more debate on both sides of that story now than you were just a couple of months ago.
Matt, do you think any of the sell-off as it deepened as the session went on was also due to tariff threats, what we heard from Trump, additional 10% on China? And we already know that the administration has been looking at additional restrictions for chips given to China.
I think certainly the restrictions more than the tariffs. I mean, Nvidia's chips are made by TSMC in Taiwan, so I don't think that's really caught by the tariff situation so much. But clearly, going the other way, import restrictions into China has hurt Nvidia already. I think that their sales into China are about half what they used to be, but they have modified chips to kind of still serve that market. They're confident that the kind of revenue base they've got there now will continue, but clearly that would be at risk if there were even stricter constraints put on the technology sector about exports to China.
Now, what's good news for Nvidia, that is the huge demand for its chips, might be bad news from other companies. We had Dell earnings yesterday, Matt, that seemed to disappoint around some of the costs for getting their hands on the hardware they need. What did we learn from Dell? Just how problematic is the current environment and the demand for these kinds of chips?
Yeah, I mean, huge demand, but obviously that there's an acknowledgement from Dell that selling NVIDIA technology to their clients is lower margin. The story from Dell, though, is that alongside those chips, they can sell a lot of higher margin products and services into those clients. So they remain optimistic that this margin dip is temporary and that they can kind of find a way around it. I mean, we have to put it in context. The company is saying that they can generate around $105 billion of revenue in this next 12-month period, and within that, about $15 billion will be from AI-related servers. So it's kind of still a relatively small part of their business, but it's growing rapidly. It'll be up 50% year on year. But yeah, the margin dilution is an issue, and they need to demonstrate to the market that they can be successful at selling these higher margin products around those NVIDIA chips.
Matt, thank you so much for joining us this morning. A busy week, I know, for you. That is Bloomberg Intelligence's Matt Bloxham. Now, currency markets and markets in general also rippling as you get the hit not just from Beijing. They are threatening to hit back on U.S. tariffs, but also President Trump unveiling that additional 10% tariff on Chinese goods. A spokesperson for the Chinese Commerce Ministry said if the U.S. insists on having its own way, China will counter with all necessary measures to defend its legitimate rights and interests. This also comes off the back of Trump confirming that March 4th would be the deadline for Canada and Mexico tariffs. Joining us to discuss is Bloomberg senior editor Bill Ferries. Bill, let's start with China and the retaliation that China is talking about. What could we realistically see from them?
Well, first we have to see if this threat is something that the Trump administration really goes through with. March 4th, yes, it's Tuesday, not very far away at this point, but there is plenty of time for a deal to be made, as we saw with Canada and Mexico just a month ago when they were on the verge of facing tariffs. But China has so far been relatively restrained after that initial 10% tariff went in from Trump early this month. They did put tariffs on some products, but they didn't. They kind of managed it to minimize some of the blowback on their economy. Obviously, the U.S. imports a lot more from China than China imports from the U.S., but it does have a lot of tools to hit American companies, hit American farmers with. So we'll just have to see whether they really need to do that. 96 hours is not a long time, but it is enough time in Trump world to strike a deal.
I mean, that is really something we learned the last time around when some of these tariffs to Canada and Mexico are delayed. But I just want to take one phrase from that tweet from Trump yesterday that really started the snowball effect of risk selling off. He talked about the idea that these tariffs were going on because of drug issues, because of immigration issues. And he used the phrase that the tariffs will go on until it stops or is seriously limited. What does that tell you about the ability of these countries to reach a deal with the U.S.?
Well, there's no clear guidelines or markers. There's no sense of like, what will it take? If you're talking about Canada and Mexico, and Trump's talking about illegal immigration and fentanyl, how much does it have to go down before they, reach a barrier that allows tariffs to be eased? That's the whole murky part of all of these negotiations. With Mexico, we're already seeing them agree to send more than 24 jailed cartel leaders that the U.S. has long wanted to the U.S. So is that the start of some kind of a negotiation that's going to gain speed over the weekend and into Monday that allows them to have this latest threat delayed another 30 days? I think that's the big question mark and what we don't know heading into the weekend. I don't think we're going to know if tariffs come in on China, Mexico, or Canada until at some point Monday evening or even Tuesday morning when we all wake up.
Bill, I just want to end it on this because we've also had a variety of different world leaders come to Washington, D.C. It was the UK's Keir Starmer yesterday. Zelensky heads to meet with President Donald Trump today. What are we expecting in that meeting?
Well, with Zelensky, we still don't have the details of this new fund that the U.S. and Ukraine are creating. We don't know what it's going to get topped up to, what the terms of it are, what it'll spend money on. I think the most important thing for Ukraine here is that they're having this personal meeting between Zelensky and Trump, that they are still having, after last week in which the two sides were really criticizing each other, the fact that these two leaders are in the same room shows that Ukraine is still somewhat near the table, if not at the table, as Donald Trump tries to rapidly strike a deal with Vladimir Putin. It is almost more of a political agreement than an economic agreement at this point. We just have to see whether it really lasts.
Bill, thank you so much for that update. Please enjoy the rest of your Friday and your weekend. That is Bloomberg's Bill Ferries. By the way, UBS's chief economist Paul Donovan writing in about the tariffs, saying crying wolf on tariffs has economic implications, even if the taxes never appear. There is some evidence of consumers buying earlier out of fear of tariffs. Firms may raise prices, and business investment is an uncertain future. Okay, let's get to some other top stories that are trending on the terminal this morning. Bloomberg sources say that the SEC has expressed concerns over a much-anticipated private credit ETF from State Street and Apollo. The regulator has concerns over the fund's liquidity and its ability to comply with valuation rules. A representative for State Street declined to comment. A representative for Apollo also did not immediately provide a comment. French inflation dropped to its lowest level in 4 years, supporting the case for further interest rate cuts by the ECB. Consumer prices in France rose 0.9% from a year ago. That is below analyst forecasts of 1.1%. The central bank is expected to cut its deposit rate again next week to 2.5%. A wave of drills by China's military in the Indo-Pacific is testing the Trump administration's commitment to regional security. The drills have raised concerns over Beijing's intentions with Australia, Vietnam, and Taiwan. The U.S. response, that is closely being watched. Some have started to question its commitment to allies. Coming up, State Street's Cayla Seder remains optimistic on stocks after yesterday's sell-off. She will be joining the program next. This is Bloomberg. This is Bloomberg Brief. I'm Danny Berger in New York. Futures are edging higher, though ahead of a last trading session of the week filled with trade tensions, geopolitical risks, Nvidia earnings, a lot to digest, and a lot that sent stocks lower this week. But State Street's Cayla Seder writes, quote, although turbulence is elevated, our measures of systemic risk indicate that the foundation of the equity market is still solid. Essentially, the risk message is buckle up, but it's going to be okay. Joining us now is Cayla Seder, macro multi-asset strategist at State Street. Cayla, I think we all need to buckle up. I think that is very wise words. But it's enough to send equities to on track for their worst week since September. Why, for you, is this just more turbulence, but not necessarily a reason to step out of the equity market?
Yeah, good morning, and thanks so much for having me. So, I think there are a couple of reasons why we still like equities. As you mentioned, our tracker of systemic risk still remains muted. And so what that means is that although turbulence is high and we expect turbulence to remain elevated, the foundations of the equity market are still really strong. And I think that makes sense when you look at institutional positioning. Positioning is still in really high quality parts of the market. So in more I would say, times when there's increased risk for volatility, you want to make sure you're in high quality parts of the market. And that's where we really see investors sitting right now. And so that would limit downside opportunity. And then when you think about, okay, what are your relative options? Do you really want to go into fixed income right now? And we can talk a little bit more about that if you want. But right now, that relative story still seems like moving forward, we like that pro stock outlook.
I actually do want to talk about that, Cayla, because we had Priya Misra on from JP Morgan yesterday, who said that she's been talking to clients, trying to convince them to get out of cash and get into fixed income because they are working as a ballast against equities. You don't think it's time yet. Why not?
Yeah, there are a few reasons. One is that we really need to look for increase deterioration in the growth story. Right now, we've seen soft data start to roll over, but we haven't really seen that in the hard data yet. And why that's important is because really, if we want to see at least 2-year yields move lower, we probably need to see more cuts priced in. And until we see more cuts priced in, you really need to see that driver probably be the growth story, because it doesn't look like inflation is rolling over.
That really speaks to this moment we're in. And I wonder how you see it, Cayla, because you could kind of make an argument for any macro setup. But how are you seeing it? Is this an economy that's too hot, too cold, just right, some maybe stagflationary combination of the three?
Some of it is the latter. However, I think it's probably too early to use the stagflationary word just yet. However, it is more uncertainty. And that's what we've really seen over the past 6 weeks, is an increase in uncertainty. What that means is we're constantly monitoring, okay, what's happening to inflation and what's happening to the labor market, and where are the risks for both and what needs to be prioritized first. And what we see right now is that, yes, inflation expectations are rising. Inflation is hotter than the Fed would like. However, expectations on the market side still look capped. And so that gives the Fed time to be patient. When we look at the labor market side, we would still categorize the labor market as balanced. But that's one reason, especially why next week we'll get updated NFP numbers, labor market numbers. That's really where we're looking to see whether or not the consumer and the labor market is weakening. And we just haven't seen that yet, but we're closely watching.
Fair enough. It's been the soft data, not the hard data. But what the markets seem to be reacting to now, Cayla, is this attempt to price in tariffs. You had Trump confirming that March 4th will be the date that you get Canada and Mexico tariffs. But to be fair, we've seen him make deals in 24-hour run-ups to various tariff impacts. Do you wait to actually see the white of the eyes of tariffs to price that in? And what does that actually look like in terms of an impact to risk?
I would say there's 3 ways we're looking at this. One is we look at our behavioral risk scorecard, which is tracking institutional positioning and flows across a variety of asset classes. And that really gives you a holistic picture of where risk sentiment is. And right now, we do see neutral to positive risk taking across multiple asset classes. And so that is telling us that long-only investors are somewhat looking through some of these risks. And then you have to ask yourself, okay, why might they be looking through tariff risk? And this leads me to the second point, which is positioning. And where we see positioning is in A, high-quality parts of the market, but B, when you look at regions, we have underweight exposure to China. There's underweight exposure to Mexican equities. Things like that look like, okay, some of the tariff risk is already priced in. And then when you look at it from a sector perspective, positioning in autos is neutral, positioning to places like pharmaceuticals, healthcare, that's already underweight. And so there are some places where tariff risks are actually already priced in, and that might be limiting some of the downside already.
Cayla, just before we let you go, in terms of the shift and the move to quality in the equity market, there seems to have been a vibe shift in tech. You saw it in Nvidia earnings yesterday with their worst reaction to an earnings set since 2018. Mag 7 looks something like of a correction so far from its peaks. Has there been a vibe shift, or will tech leadership come back at some point?
We think it's too early to abandon tech. However, when you think about the vibes and the uncertainty, where we do see increased appetite is for defensives. And so, when you're thinking about where you want to increase exposure, defensives, especially places like, say, consumer staples, if you are concerned about the consumer, that could be a low beta, still relatively high quality part of the market to shift some of your allocation to. And so really, if you're thinking about, do I go into cyclicals? Do I go into defensives? Now could be a good opportunity for more of that defensive story.
Cayla, so wonderful to have you on. Thank you so much for joining us. Cayla Seder of State Street. Enjoy the rest of your Friday and your weekend. Coming up, a multi-trillion-dollar fat finger. Oops, one customer was credited $81 trillion by Citi. We'll have more on that story next on your Bloomberg Brief. Let's take a look at the front pages this morning. First up, the New York Times leading with a federal judge ordering the Trump administration to retract memos that prompted the firing of thousands of federal workers. He said the directives were illegal and suggested that the layoffs be stopped. Next up, the Wall Street Journal has this. The Transportation Secretary, Sean Duffy, saying the government is attempting to hire more air traffic controllers and upgrade the aviation system. The FAA will boost pay for students at its Air Traffic Control Academy. The FAA has struggled with low staffing for years, often leading to flight delays, which I'm sure many people out there have experienced. Okay, this from the Financial Times. You have to read it to believe it, that Citi accidentally credited $81 trillion to a customer's account last April. The amount was supposed to be much less more than that. As you could imagine, the transfer was missed by 2 employees and detected by a 3rd employee 90 minutes after it was posted. A Citi spokesperson said the incident had no impact on the bank or its clients. A total of 10 near misses of $1 billion or more occurred at Citi last year. I would love to see anyone attempt to pay a bill of $81 trillion. Okay, coming up, we have inflation data on deck. We will set you up for it. We catch up with Bloomberg's Mike McKee. This is Bloomberg. From our global headquarters in New York, welcome back to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Beijing's warning China vows to hit back with all necessary measures after President Trump unveils additional tariffs. Meanwhile, trade jitters send stocks across Europe and Asia lower. U.S. futures and the dollar is higher. Pushing back on private credit for the masses, the SEC raises concern over Apollo and State Street's private debt ETF. We catch up with Robin Doumar of Park Square Capital on the state of the industry. Back into the red for the year on U.S. stocks, and we are headed for our worst week since September. We move higher in U.S. futures this morning, up 1/3 of 1%. NASDAQ 100 up 0.2% after Nvidia sold off 8.5% yesterday. It is moving higher. The concern for these markets have been new tariffs. President Trump tweeting about the idea that we will be getting Canada and Mexico tariffs on Tuesday, additional 10% for China. You did see inflation swaps move higher, but there was a bid into the front end of the curve yesterday. Your 2-year yield, that is unchanged this morning. 10-year yields move lower by about a basis point. They're at 4.24. That 2-year yield, by the way, is falling to around a 4-month low. So as I said, Beijing has threatened to hit back after President Trump unveiled an additional 10% tariff on Chinese imports. A spokesperson for the Chinese Commerce Ministry said if the U.S. insists on having its own way, China will counter with all necessary measures to defend its legitimate rights and interests. As I said, the president also said levies on Canada and Mexico are on track to take effect on March 4th. Joining us now to discuss is Bloomberg's Tyler Kendall in Washington. So, Tyler, what does the calendar look like now for tariffs?
Yeah, Danny, well, the calendar's been expanded, right? Originally, we were expecting these March 4th tariffs to go into effect, and they'll come alongside, as you mentioned, those tariffs against Mexico and Canada as well. And it's important to keep in mind this entire set of tariffs, including the impending tariffs against China, are really tied to some tangible policy priorities for this White House when it comes to immigration and also fentanyl. You heard President Trump yesterday renew his accusations against China when it comes to illegal drugs coming over the U.S. border. border. And Bloomberg News reporting, though, that this announcement, particularly against China, really caught officials in both countries by surprise. But it does continue what has been recent action by this administration against China, including renewing investment curbs against Chinese investment flows coming into the U.S., also proposing heightened fees against Chinese-made vessels that ship U.S. goods. And then just lastly, Danny, Bloomberg News reporting that just last week here in Washington, U.S. officials asked Mexican officials to hike their own tariffs against China, too.
We saw in President Trump when he tweeted yesterday, he had this phrase, Tyler. He talked about we can't allow this to continue in the U.S., referring to China and Mexico and the concerns about drugs and immigration, saying, quote, until it stops or is seriously limited. Does it seem like there is scope, there is a way for Canada and Mexico to avoid the tariffs come Tuesday?
Well, Bloomberg News is reporting that U.S. officials are looking closely, particularly when it comes to overdose deaths, when it comes to this issue. And recent data shows us that those deaths actually are dropping. Most recent federal data showing overdoses killing roughly 240 people per day. So we'll have to see, though, if that could be enough progress. President Trump yesterday in the Oval Office saying that he's not impressed when it comes to this. We know that, for example, Mexico has also sent about 10,000 troops up to the U.S. border. Canada has implemented its own fentanyl czar to try to crack down on this issue. But it really does seem to be playing more broadly in these connections to China. We'll have to be watching if they take any specific actions against China to curb this immigration and also the fentanyl as well.
Tyler, just finally, we've had a variety of world leaders come to the White House, come to Washington, D.C. It was the UK's Keir Starmer yesterday. Today, Ukrainian President Volodymyr Zelensky will be heading to meet with Trump. What are we expecting out of that meeting?
Right. Well, he's expected at the White House at 11 a.m. Eastern. Then maybe we'll get a few additional details at a 1 p.m. Eastern press conference. And the biggest thing on the table is we're waiting to see if this White House will commit to any firm U.S. security guarantees. President Trump previewed yesterday that they are expected to sign a critical minerals deal. But Bloomberg News is reporting that we are not expecting those security guarantees to be inside that deal. It comes after, of course, French President Macron was here earlier this week, and Keir Starmer was at the White House yesterday trying to press the U.S. when it comes to this. Both have floated that they are looking into some sort of framework to get European peacekeepers on the ground in Ukraine, but they have suggested that they would like the U.S. to underwrite such a deal. But President Trump sidestepped those questions yesterday, saying that he doesn't want to talk about any of those guarantees until a firmer peace deal is in place. Instead, he has been citing this critical minerals deal as being a sort of an implicit security guarantee when it comes to this, saying that the U.S. would have a vested economic interest in Ukraine's future. But importantly, that is not what Ukraine would like to see. And Zelensky has repeatedly said that U.S. aid to the country negotiated under the last administration does not amount to a debt that Ukraine needs to pay back.
Tyler, we really appreciate the update. That is Bloomberg's Tyler Kendall in Washington. Now, we are just under 3 hours away from the latest PCE and personal income and spending data. Let's bring in Bloomberg International Economics and Policy correspondent Michael McKee to help set us up. Mike, PCE, I mean, we kind of know what this is going to be, right? What are we expecting?
It's a little bit of managing expectations here after some bad economic news, inflation news over the course of January for CPI, PPI, et cetera. This one could come in a little bit better because we're able to calculate a lot of the things that go into the PCE. And now you can see what economists are thinking, that we get a 0.3 for both the headline and the core, and that pushes down both the headline and the core on a year-over-year basis, which is not what we saw in CPI. And it would give the Fed the idea that perhaps we're starting to see progress again on inflation. However, we also get some spending numbers here, and there you can see what we're looking at in terms of the overall inflation numbers. The orange there is services. That includes housing, and that's still the big issue. But everything below that is below zero on this chart. So we're starting to see some progress there and hoping that continues. The spending numbers will be key, though, because if the American people cut back and we had a bad retail sales report, then the Fed is is maybe going to have to think about cutting rates, not because inflation's going down, but because the economy is softening. I think we're still many months away from that kind of decision, especially since we've got more and more and more Trump tariff news to try to digest.
It's so true, but there has been this concern that the sentiment data has been soft. Is there any sign of that at all so far, that that's starting to creep into some of the harder data?
Well, we've seen a couple of things that are giving economists pause, one of which is the fact that the retail sales data was not great. We'll see what happens with the spending data today. The biggest thing, though, is that recessions are confidence issues. People lose confidence and stop buying, companies stop producing, then they lay off people and you go into recession. So you got to keep an eye on what people are thinking about the economy. I don't think people are ready to give up yet, but there are some signs that people pulled spending forward, bought stuff like in December because they were afraid of tariffs to come.
Yeah, something Paul Donovan at UBS has been talking about, the crying wolf on tariffs has economic implications, kind of talking to what you're speaking of pulling things forward. In terms of the Fed reaction, it's this constant tricky line of how much do they incorporate tariffs and some of the consumer changes in behavior to it. Have we heard any indication that their thinking is evolving on that front, or they're even willing to wade into that?
They're not willing to wade into it. What they've been doing is all their research directors have been tasking their staffs, if this happens, if this happens, if this happens, run a model and see what you think the effects are going to be. Once we get those tariffs that keep getting pushed back and pushed back, then they can model it, figure out what they think might happen, and then start to decide whether there's any monetary policy that can address it. A lot of the feeling is comes in once, raises the price level, and then it doesn't keep happening. And if that's the case, then the Fed probably looks through it.
Well, next week could be a very interesting week for that if we do indeed get Canada and Mexico tariffs on March 4th. Mike, thank you so much. That is Bloomberg's Mike McKee. By the way, the latest flow show from Bank of America coming out saying that there's been a record outflow from crypto, a record inflow to gold, and interestingly, the biggest week of U.S. stock inflows in 2025, despite the fact we've seen a sell-off in recent days on those tariff concerns. Let's now get you some other stories that are trending on the terminal this morning. Some German industries are beginning to plan for when Russia gas returns to Europe as President Trump pushes to end the war in Ukraine. Europe has spent 3 years weaning itself off of gas from Russia, with the biggest impact being felt in Germany. Rising energy prices have hit growth and forced some manufacturers to move production abroad. Elsewhere in Europe, French inflation dropped to its lowest level in 4 years, supporting the case for further interest rate cuts by the ECB. Consumer prices in France rose 0.9% from a year ago. That's below the analyst forecast of 1.1%. The central bank is expected to cut its deposit rate again next week to 2.5%. Now, a number of drills by China's military in the Indo-Pacific is testing the Trump administration's commitment to regional security. The drills have raised concerns over Beijing's intentions with Australia, Vietnam, and Taiwan. The U.S. response is being closely watched, with some questioning its commitment to its allies. Now, I mentioned that statistic from Bank of America that there have been record outflows from crypto in the past week. You can see that clearly reflected in the price. We are back below 80,000. We're down some 27% from the peak of Bitcoin. By the way, Michael Hartnett of Bank of America also saying that the Trump put is at 5,783 on the S&P 500. That's when he says some of the pain stops and we might get a reaction from the White House. Coming up, we speak with Robin Doumar, Park Square Capital, on the opportunities and challenges of private credit and the convergence of both private and public. That comes up next. You don't want to miss it. This is Bloomberg Brief. I'm Danny Berger in New York. Now to a Bloomberg scoop. The SEC has expressed concerns over a much anticipated private credit ETF from State Street and Apollo. The regulator cited the fund's liquidity and its ability to comply with valuation rules, among other concerns. I'm pleased to say that joining us now is Robin Doumar, managing partner and founder at Park Square Capital. Robin, I mean, this is your world. It's not the ETFs, but the private capital, the private credit of it all. Does an ETF wrapper make sense for this asset class?
I think ETFs in equities make a tremendous amount of sense. Very low cost product, very hard to beat for single name asset pickers when the entire market is moving up. So it's a very good way for equity investors to get exposure. In credit, by contrast, I don't think it's an interesting product broadly, and I won't reference any one product, but The asset class of an ETF for credit, I think, is questionable because there's not liquidity in necessarily the underlying names, particularly as you get more private. But to me, the bigger concern is the broad market is not attractive. It's a market where the key to performance is avoiding zeros and avoiding mistakes. And so there's just a lot of sewage in the broader market, and it's not an index that I'd like to own.
I know this is what sets you and Park Square apart from others, and that other private capital, private credit managers try to be everything to everyone, but you're quite selective. So what don't you like at this moment? What in the broader market would you be trying to avoid right now?
So what's key to us is to stick to high quality, stable, predictable businesses. We like things like software, healthcare, business services, high margin industrial companies. We have no automotive exposure, no automotive suppliers, no retailers, no chemical manufacturers, no packaging, no airlines, no cruise ships, no things in hospitality or restaurants. So really a super selective approach and very service-oriented approach, which for Europe, as we think about things like tariffs and other possibilities, means that I think we can sleep comfortably at night in terms of the portfolio.
How do you incorporate tariffs in? Are you at a point where you just picking things that have no exposure, or are you waiting till you see actual policy announcements from the U.S. to make those kinds of decisions?
So we're always careful to avoid what we view as cyclical manufacturing businesses and export-import businesses. We really have almost no exposure to that. So that's really a good first step. I think the other thing that's so terrific about private credit generally is we don't have to worry about it, really, which is to say we are floating rate investors, and the biggest impact that we may see in a macro sense from tariffs is on interest rates. And so by being interest rate protected and floating rate, I think just it's a wonderful asset class for this sort of environment where equities are, risky and where traditional fixed income has been disrupted and constantly disrupted by the trajectory of interest rates.
Well, I have to press you on your outlook for that then. Are you concerned that inflation will remain sticky or move higher with tariffs and therefore disrupt and make it harder for some of these companies to have elevated rates they need to pay?
The great news, Danny, is I don't have to worry about it too hard.
Okay.
Because if we do see an increase in base rates, that's very good for us because we're a floating rate investor. It's great for our investors. If we see things move down a little bit, it's very helpful in terms of overall credit quality. And so I think, again, it's that floating rate asset, which is so attractive. And I think that's why you're seeing such deep interest across the board in private credit, which is in this kind of environment in particular, where equities, again, seem to be very fully valued and where fixed income seems very volatile. It's just a nice way for investors to get a very attractive return.
On that point of volatility, though, there's this classic illiquidity premium that's talked about with private credit that you don't have to mark to market. If we are heading to this world of going back to sort of the ETF conversation, where there's this convergence of public and private assets get traded more, Apollo has a trading desk now to try to trade some of these things. Does that illiquidity premium start to shrink as more of these different assets, more of these different funds, and private credit needs to be marked to market?
I think at the large end of the market, we are seeing convergence. It's not particularly new. It's much talked about now, but we're definitely seeing it where the very large asset managers can step in and speak for an entire transaction, even if it's $1 billion, $2 billion. I mean, these are, really large sums. I think what people may lose sight of is there is no liquidity to create if one or two individual institutions own a loan. If they don't want to sell, there's no liquidity. And so I'm not sure where the liquidity comes from in some of these very small syndicates. Now, in a big syndicated loan with 50 plus investors, there's going to be, probably pretty reasonable liquidity. But I think you definitely are seeing convergence.
But it's only happening on, again, the sort of bigger asset side. So is it kind of overhyped, this idea of everything's coming together? There's the lines blur. They're all the same. I mean, it's something that we've heard from, I know we don't need to talk about individual names, but Mark Rowan talks about this a lot, that it's happening and it's happening everywhere in private credit. Is that just a bit too far?
I think it's absolutely correct that the convergence is happening. I think it's a bit overhyped. I think for the very large asset gatherers, they're seeing a lot of pressure on their portfolios where the syndicated loan market today is refinancing them. And the syndicated loan market is white hot. It's very aggressive. We're back to territories that we haven't seen in years where syndicated loans are pricing at 300 over, if not inside of that, 275, 300 in the U.S. That's a far cry from 5 over direct lending areas. And so I think what you're seeing is some of the big asset managers desperate to defend their portfolios. And I think it's going to have a bad effect, frankly, on performance.
Okay, a bad effect on performance. I also wonder what the effect on behavior will be, because private credit, it's an asset class of norms. There are certain things that managers could do, but perhaps don't do. Again, because of those norms, you see it broken every now and then, the creditor-on-creditor violence. Public markets have different sets of norms. If there is this convergence, do the norms also converge? Do you see more, I guess, creditor-on-creditor violence, those sorts of things happening?
I think you're spot on to talk about norms, and I would put it slightly differently, which is alignment of incentives. I think if you think about banks, syndications, the public markets, people think in a very short time frame. How is a position doing today? What is the mark? How can I get rid of it? If you think about private credit, we're thinking about multi-year commitments, owning things. It's hunter-gatherer versus farmer. It's a very different alignment of incentives. We're incentivized to make sure that our investors get a very good return over a long period of time. Be very careful. Choose your assets really well. Sit and monitor things carefully. Have radically transparent discussions about performance internally. All those things are very difficult to do in big organizations like banks that are very focused on daily marks.
Robin, I just want to end with this, that we've seen in public markets, U.S. equities have struggled. U.S. debt, as you said, has been volatile, at least treasuries have. While Europe has all of a sudden got all this attention, while European equities are at all-time highs. I know you sit in London, so you've been investing in European assets for some time, but has the same happened in private credit? Has there been a realization of an opportunity set in Europe?
I think there is a very similar phenomenon going on. So I think you're spot on that what we are seeing is that Europe is cheap. Europe is less well served from a capital market standpoint. And now I think with U.S. markets, both equity and credit markets, feeling frothy, where investors are struggling to see value in some cases, there is now a clear recognition that Europe looks really super interesting. And we're starting to see this in transaction activity, where, for example, public to private transactions, take private transactions, look really interesting because Europe is so inexpensive. So we're definitely starting to see this factor through into markets.
Robin, it's been too long. It was so great to have you here.
It's great to be here.
Thanks
Thank
for
you,
stopping
Danny.
by the set. Robin Doumar there of Park Square Capital. You're welcome back anytime you're in the city. Okay, coming up, we're going to be wrapping up the week with PCE numbers. President Zelensky also heads to the White House. We will set up your trading day on your last trading day of the week. This is Bloomberg. Made it to Friday. Let's get you set up for your trading day on the last day of the trading week. PCE, inflation, personal income, and spending data. All of that comes out at 8:30 a.m. Eastern. Then Ukrainian President Volodymyr Zelensky will be meeting with President Donald Trump at the White House at 11 a.m. Some Fed speak to watch out for. Chicago Fed President Austin Goolsbee will be speaking at 10:15 p.m. Eastern time at a Stanford event. Some stocks to keep your eye on. Nvidia, that is back up. It's leading the rebound in Mag 7 stocks. Those shares up just 0.8%. They closed down more than 8.5% in the last session. DZ Bank also raised it to a buy. Dell, that is extending its post-earnings drop, down 2.5%. Investors concerned about AI hardware profitability. And rounding things up with Monster Beverage Corp, they make the energy drinks. Those shares up 2%. They had better than expected margins that boosted shares. Now, overall, equity markets trying to find their feet. We are on track for the worst week since September. The concern about tariffs sending them lower, but strong inflows for the year, according to Michael Hartnett over the past week. Okay, that is it for Bloomberg Brief. The surveillance team will take things from here.